If you choose a simple 25 rupee coffee over a 125 rupee cafe drink and invest that 100 rupee difference at a 15% annual return, that single daily decision grows into 26,786 rupees over 40 years. Building a fortune doesn't require a massive initial lump sum. It requires a mathematical system. Most people stay poor because they are unaware of the force destroying their savings in real time: inflation. We measure this destruction using the rule of 70. At a 6% inflation rate, your money's purchasing power cuts in half roughly every 12 years. In half a century, a 1 crore rupee fortune erodes until it buys what 5.43 lakh buys today. Saving cash is a guaranteed loss over the long term. For your wealth to even survive the passage of time, it must grow. Compounding is the mathematical cure for that erosion. Albert Einstein called compound interest the eighth wonder of the world, noting that those who understand it earn it, and those who don't pay it. The engine is simple. You earn interest on your principal, and then you earn new interest on that previously earned interest. In India, the Nifty 50 index, tracking 50 of the nation's largest companies, has served as a primary vehicle for this growth over the last 2 decades. Over 20 years, fixed deposits averaged 6 to 9%, and gold between 11 and 14. The Nifty 50 delivered a 12.4% return. This includes the 2008 financial crisis, where the index dropped 51.3%, before robust long-term compounding recovered and continued upward. Historically, broad equity compounding has proven powerful enough to outpace inflation and maintain significant real returns across multiple market cycles. To calculate this growth without a spreadsheet, you can use a mental shortcut called the Rule of 72. If you divide 72 by your expected return, say 12%, you find that your money doubles exactly every 6 years. The same logic applies to the rules of 114 and 144, which pinpoint exactly when your initial investment will triple or quadruple. To put this math into practice, most investors use systematic investment plans, or SIPs, investing a set amount every month. At 12%, a $5,000 monthly SIP takes 26 years to reach 1 crore, while $10,000 cuts it to 20 years. After 10 years, the curve shifts. Accumulated returns rapidly outpace actual cash contributions, expanding to dominate the entire portfolio. Extreme wealth is less about a high starting salary and more about the length of the investment timeline. If the math is this reliable, why do most retail investors fail to build a fortune? They sabotage themselves. Emotional biases lead people to buy during peaks of greed and sell during the depths of market anxiety. Warren Buffett advocates for extreme long-term discipline, maintaining a position while the rest of the market reacts to short-term panic. SIPs are designed to protect you from these psychological flaws through a mechanical process called rupee cost averaging. When markets are high, your fixed 5,000 rupees buys fewer units, but when markets dip, that same 5,000 rupees automatically buys more units at a severe discount, lowering your average cost. You can speed this up even further with a step-up SIP, increasing your monthly payment by 10% each year to match your income growth. Systemic discipline outsmarts both inflation and human error. Start small, use the calculator in the description, and let the math work.